Hey everyone, welcome back to Corporate Decoder, the place where we decode all the corporate mumbo jumbo for you. Today we are diving into Guided Therapeutics' latest financial report. Let me tell you, this one is a wild ride. It's like watching a car crash in slow motion, but with more debt and fewer survivors. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. So Guided Therapeutics, they are a medical tech company. They're trying to make devices that can spot cancer without cutting you open. Their main product is called Luviva, and it's supposed to detect cervical cancer by shining light on your cervix, hopefully finding something useful. This report is a 10Q, basically a quarterly checkup. This one covers the first 3 months of 2025 ending in March. First thing you'll notice, they had almost 79 million shares outstanding as of May 2025. Translation, there's a lot of this stock floating around, which can make it harder to increase the price. Alright, let's dive straight into the numbers because that's where the real story is. Brace yourselves. First, let's peek at the balance sheet. It's like a snapshot of what the company owns and owes. Okay, their total current assets at the end of March were just a little over $800,000. That's what they can quickly turn into cash. Total assets, everything they own, were under $1 million, less than $1 million. That's not a ton for a company trying to launch a medical device. Now for the scary part, current liabilities were almost $6 million. That's debts due within the next year. And finally, accumulated deficit sits at a whopping $154 million. Translation, they've lost a lot of money over time. Let's move to the income statement, which shows how much money they made, or in this case, lost. Their sales for devices and disposables, zero, nada, zilch. Meanwhile, they spent over $400,000 just to keep the lights on. Ouch. And they had to pay over $140,000 in interest to the lenders. That really hurts considering what we just saw, which all adds up to almost $500,000 lost. And this is just for 3 months. Finally, let's check the cash flow statement, which is a real-time picture of where the money's coming from and going. They burned through over $300,000 just to keep the business running. That's never good. And that leaves them with barely over $100,000 in cash at the end of March. That's not a lot of runway. Now, the notes are really important because they explain a lot of what's going on behind the scenes. There's a whole section about whether they can even stay in business. This is never a good sign. They state directly that their financials raise substantial doubt about the company's ability to continue as a going concern. The auditors are basically waving a red flag here. They did manage to get some cash by selling more stock and warrants, which let investors buy stock later, but that dilutes existing shareholders. They also have a ton of convertible debt, which is basically loans that can turn into stock. Great, more dilution. Looking at what they owe, they seem to be in a constant struggle to keep current. It's a balancing act that's clearly not working. They even talk about how their prospects must be considered in light of the substantial risks, expenses, and difficulties encountered by entrants into the medical device industry. They practically acknowledge that they're in a tough spot. First thing, there are no major legal problems. That's a small win, I guess. And they say there have been no major changes to the risk factors from their last annual report. So all the problems from last year are still problems now. There's a lot of forward-looking language, which, remember, are just guesses about the future. They're hoping for almost $2 million in sales from China and just a little more if you include sales to Turkey and Indonesia. But and it's a big but. They admit that they can't guarantee they can find additional sales and those could be cancelled before happening. It sounds like Dr. Faupel, the head honcho, is betting big considering the company may collapse at any moment, so it makes sense to downplay it. Alright, that was quite a report. Let's pull back and see what this all means. So the company is in a difficult spot. They're losing money, they have a ton of debt, and they depend on things outside their control like regulatory approvals and buyers showing up. Their main strength is their technology if it actually works. Their weakness is, well, basically everything else. It's high risk, high reward. If you are looking for slow and steady, you should probably avoid. What are some big risks? Well, if Luviva doesn't get approved, that's a huge problem. Also, they need to sell a lot of devices to pay off all that debt. If they can't, things could get very ugly. What are some potential opportunities? I mean, if Luviva works as they say, and if they get the approvals, and if they can scale up production and sales, then maybe, just maybe, they could turn things around. But that's a lot of ifs. Honestly, this looks like a classic turnaround situation. High risk, high potential reward. So buckle up because it's going to be a bumpy ride. Alright, that's our breakdown of Guided Therapeutics' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.